Hello, everyone. So we already have Tara here, and it is the time to start. Welcome to this session. We have Tara Collier, who is going to deliver the keynote, the second keynote speech today on impacting finance. So I will start this session by introducing Tara to everybody, including audience online. And Tara is a global strategist, advisor, impact investor, and public speaker. And she is the climate lead and director of the impact investing of Chemonics UK. So she actually has done quite a lot on grant investment projects across multiple countries. I do not need to mention the countries, but from developed economies to less developed economies. So that means that she has a lot of experience in practice in terms of impacting investment. And Tara has a very interesting academic background. She had her MBA from Oxford University as a scholar. Actually, I do not know the meaning, but I guess it's a kind of, reward award or something. And she earned her MPA in international public non-profitable organization management from New York University. And she has a BA in Spanish and international affairs, which is very interesting. Maybe that helps you to travel so many different places and then put your foot on the ground and do the things. So I think currently Tara is associated as a fellow with Sabre Business School, Oxford University, as we all know, is a very good business school. And also, she has advised a lot of international organizations, governments, et cetera, et cetera. But please go to the website if you need more information. So I'm very pleased to introduce Tara to you. And Tara, the floor is yours. So we are looking forward to your speech.
Thank you all so much for receiving me here today. As was stated, my name is Sabre Collier, and I'm a global advisor, strategist, impact investor, and speaker. Worked across 60 countries alongside governments, DFIs, family offices, foundations. And I'm here to talk at your request about rethinking growth and finance in a fragmented world. And I can't tell you how pleased I am to be here to talk about it because, everyone, it's a matter of urgency. We've now passed the 1.5 degree threshold as declared by the UN recently. 7 of the 9 planetary boundaries have been crossed, threatening life on this planet. And at the same time, the world's billionaires have more wealth than 4.6 billion people, with these levels of inequality threatening political stability for most of us, even here in the UK. So I say that to contextualize the global challenge in front of us before zooming into the topic of impact investment and private sector finance. I want to contextualize the challenge that impact investment and development finance have been intended and have been set up to address, because that challenge itself is morphing. And I've given some of the grounding around that. We can't turn this ship around as far as the planetary boundaries and the mounting inequality. We can't turn this ship around without some radical changes here at home in the OECD. And I mention that in the context also of the increasing isolationism and inward-looking focus that you see in OECD countries. We can't do that internally, but also very important to add, especially in this context of division and inward focus, we can't do it without the emerging markets and developing economies, which I'll be calling the MDs over the duration of this talk. So first, I'll shed light on why I believe this to be the case, why we can't do it without the MDs, and then we'll dig into impact investing, private sector finance. We'll look at some of the headwinds that have hit impact investing and private sector finance, particularly to emerging markets and developing economies. But I promise I won't leave you depressed on a Friday. We'll also look at some of the silver linings, some of the emerging research, investment transactions, and movements that may comprise, that I desperately hope will comprise, part of the solution. So why do I say MDs are a critical part of the equation? And as I mentioned, I'm starting with that because of the era we're living in, where people just want to look inward, where some might say or allege that humanism is dead, where some might say or allege we need to look after our own, where some might say or allege we've got enough problems at home. The reason why I want to ground this in MDs being a critical part of the equation for all of us is because none of us can grow the way that we used to at a national level, whether or not you believe that we should. The most likely way to get there is through trade and investment that must include trade and investment to and from MDs. There's simply not enough renewable energy to power all of this. There's not enough agriculture to power all of this. There's not enough jobs to power all of this. There's not enough capital. There's no one market that has enough of everything to solve the mounting challenges. So I'll do a whistle-stop tour through why I think at any level of regional blocks, we're blocked without each other. And then we'll talk about impact investing and what are the big barriers. So starting at home, as we all know, here in the UK, growth has been sluggish. It's a big problem politically, and that's across the Eurozone. Yes, our unemployment is only about 6%, but the labor demand is softening. And even in this compressed job market cost of living crisis, the climate shocks could cost the Eurozone up to 5% of GDP by 2030. It's a hit comparable to the global financial crisis in an environment where there's backlash against climate policies. So where would we go looking for more growth and trade and investment? Well, historically, a big partner for that, as we all know, has been my homeland, the US. I'm not going to get into all of the issues that are facing there and why, on a political count, we can see recession or retrocession there. Something else that's quite interesting, even if you look away from trade, if you look at investor sentiments, we survey lots of institutional investors because we run lots of programs that are about fomenting investment into emerging markets and developing economies. And what's been interesting is how many institutional investors in Europe questioning whether or not they're overweight in the USA, and questioning whether the political stability, which is linked to the levels of inequality, which are the highest in the US than they are anywhere in the OECD, could affect the viability of this as not just a global reserve currency, but the kind of partner that we can all bank our growth on, as we have in the past. So whether or not you're talking about trade flows, even if you were just talking about investment flows, and we can talk about trade flows as well, what region would rise to the forefront then? If you wanted to move some of your portfolio, and we know the growth rates in Europe, US has this problem, where would you look? Well, I mean, obviously Asia is the fastest growing region, specifically South Asia, and it's home to 60% of the global population, projected to reach 5.2 billion by 2050. Strong GDP growth of about 5%. But even if you look there, it's threatened by the same perils that I just mentioned before that are affecting the US, the inequality and climate change. So whether we're talking about it as an investment source or investment destination or an export market, its potential is also linked to the ability to have inclusive climate-friendly growth. Look at Pakistan, where a third of the population was hit by floods. Look at that, how that would affect your investments if you were investing, let's say, in Pakistan. I mean, nearly half of global heat-related deaths between 20 2000 and 2020 occurred in Asia. Okay, so fine. Maybe Asia, it's a big market, certainly worth going to, but you can't move all your eggs to that basket. Where else are we talking about? Well, Africa has the world's youngest population. It could power the global workforce, especially when people are thinking about where there's enough of a young force as the populations age in other countries. That's great, but there's not the mechanisms to create jobs in all of those countries, which is why it has such high youth unemployment. It has 30% of global critical mineral reserves, but how would investors and development partners enable Africa's growth on the back of those without further stripping the planet, let alone creating inclusive and green jobs? Africa could be an amazing renewable energy and agricultural supplier for the world, but wouldn't that take a lot more financing? And oh, by the way, we're not seeing that financing come from within, and we're not seeing it come from without. So I say all of this to ground the fact that the growth, the path to green and inclusive growth, is unlikely to be fully funded and generated internally within one nation or within one bloc. We can't really do it without each other, and we certainly can't do it without the emerging markets and developing developing economies that hold 80% of the world's population and a vast amount of the minerals that we all rely on. So with that, now I hope universally accepted, or at least some openness to that as grounding for why, regardless of whether you're a humanist or not, regardless of whether you feel any sense of global solidarity or not, with that as grounding for why the trajectories, the economic trajectories for green and inclusive growth and emerging markets and developing economies is a must. Let's talk about the barriers. And the barriers to that growth have a lot to do with financing, although they also relate to policy issues. So most global capital is circulating, and I believe we all can just see this, amongst the OECD financial hubs. That's been our historical path. The OECD comprises just under 20% of the world's population, over 40% of global GDP, over 80% of institutional investment is directed to developed economies with a focus on public markets. So that addresses and relates to part of what many of us work on in our day-to-day, which is the fact that the capital flows aren't going where it's needed most, whether you're talking about in terms of job creation, whether you're talking about energy production, agricultural production, or sheer numbers of human beings. So when it comes to capital flows, the plumbing is a bit broken. And I'll illustrate further with a few stats. And this is particularly in regards to the climate finance flows in particular, given that it's 80% of the world's population. Despite emerging markets and developing economies representing 90% of the global population, outside of China, they only receive about 14% of climate finance. So most of the climate finance is in the OECD itself. Africa specifically, which as I mentioned, could power the global workforce, and where there's great vulnerability to climate change, it needs about $250 billion annually for climate adaptation, and it's receiving less than 6% of global climate finance. Another jarring stat to just put it in perspective, Latin America, which has the Amazon, which is the lungs of the planet, its green bond issuance is only 30 billion. Can anyone guess what's the green bond issuance in Europe alone? $300 billion. And part of that relates to what we'll talk about as well, which is the history of climate finance in these markets, which to a large extent has been driven by development finance and overseas development assistance historically, with Latin America, as the example we were just talking about, receiving about 60% of green infrastructure investment through DFIs. And that relates to a trend that we'll come to later, which is how do we need to change our dynamics in order to change the plumbing? And then given this context of these other stats around the amounts of climate flows, Asia, which has the bulk of the world's population, adaptation funding remains under 50 billion. And you can see how life-threatening that is in terms of human lives when you think about the Pakistan example I just gave, where 30% of the population were underwater. What could adaptation mean? What could adaptation funding mean there in terms of human lives? So there's a lot to do to fix the plumbing. And I wish I could say, oh, there's all of this to do to fix the plumbing and we're on track and it's going to get better because we've been working at it for 80 years. But actually, it's gotten a lot harder. It's been a year of major headwinds. I guess we all know why. And I won't be shy to talk about the fact that we faced a black swan event in 2025. I mean, what those of us in the development sector like to call a black swan event, because for the first time in 30 years, all of the big donors, or at least the four major providers of development aid, USA, Germany, UK, and France, all four simultaneously announced cuts to ODA in 2024. And that's one thing to deal with. People were probably trying to get on their feet from that. And then as many people are aware, in 2025, over 90% of USAID supported programs were suspended, creating a further $60 billion funding gap. And I wish I could tell you that's all over, it's going to get better. But the OECD estimates a significant decline in ODA going forward, with an estimated 9 to 17% drop in 2025. And the outlook up to 2027 suggests a potential cut of 10 to 18% over the 2024-27 period. So with all of that, I hope I'm not depressing you yet. I really don't want to. With all of that as context, it's pretty obvious the implications for private capital mobilization to the UN Sustainable Development Goals and emerging markets and developing economies. It's more important than ever. We needed it before, now we need it more than ever. The UN SDG finance gap, so the amount of money missing to reach the SDGs, has been estimated at 3 to 5 trillion annually, and ODA before the cuts was about 250 billion. So we already had a gap. And the irony is that 10 years ago, the billions to trillions agenda was set. Does anyone know the billions to trillions agenda? If you do, raise a hand. The billions to trillions agenda, thank you, was set in Addis with the intention that overseas development assistance could mobilize more than 10x from the private sector. But over 10 years on, it hasn't actually worked out the way we envisaged. Contrary to the goal of bringing money into developing nations, a 2023 G20 report found a net outflow, with 68 billion more flowing out of poor countries than flowing in, leading one World Bank official to call the initiative a fantasy. Now, the estimates range for this because it depends on if you're referring to ODA, aid, humanitarian, ICF. There's a lot of different characterizations for the types of funding, but the estimates range from 0.37 capital mobilization from MDVs to private finance to about a 1-to-1 ratio for ODA. And it's worth mentioning, as I said, there's a huge range in the estimates, not just based on the types of aid, but also how private capital is defined. Sometimes development finance is considered private capital, and sometimes it's not, because this money actually comes from the private sector originally, even though it's intended to be commercial. Independent of the definitions used, we know it's not hitting that billions to trillions. And I have a few non-exhaustive factors that have played a role in this. And I'll note that many of them are interconnected. One factor is the risk appetite of many, but not all DFIs, i.e. development finance institutions. I'll share some links subsequently, but some of the critiques from the likes of The Economist or the Financial Times have been that DFIs have acted more like commercial institutions, which, by the way, is fair because they need to be self-sustaining in many cases. But the critiques are that they have not done enough, often enough, in regards to deploying capital to the markets where it is most needed, and or to take the kind of catalytic or concessional positions and cap tables that would crowd in more commercial capital, and or going into the types of sectors and innovations that would advance the SDGs at a more considerable scale. Another factor in the gap to reach the billions to trillions target has been the types of instruments. Grants are not enough, and there's various reasons why grants are not enough. So for example, if you're raising money for a fund from a DFI, they'll say, well, why can't it be more than 20% of your fund or 25% of your fund? Guess what? Even if you've gotten a grant for 10 million and they want to put in 10 million or 20 million, the grant doesn't count to that. So grants are not enough, even though grants certainly help with technical assistance, OpEx. We need more instruments, and I'll talk a little bit about guarantees later, because the OECD is collecting a lot of data. Others are collecting a lot of data about the power of guarantees, and there's a lot of potential and innovation from guarantees. We need more of them, and there's more activity happening with them. But we also need more liquid products. A lot of development finance, particularly in the impact space, has been in private markets. And I, as an individual, actually have a lived example of this. I said, I want to take my investment portfolio and I want to try and have it match my values. And I would like people to think through this. It's much easier to take your, Hargreaves Lansdown, your pension, or if you have an investment portfolio, and put it in a mutual fund or put it in the stock market, where if you need, your kid needs to go to college, you can get it back, as opposed to an impact fund, which says, we'll try to get you your money back in 5 to 10 years. We call this liquidity. For those who spend less time in this area, we call this liquidity. And we do need more liquid products when it comes to development finance and impact finance, but particularly when it comes to emerging markets and developing economies. Lack of policy alignments in country. I don't have to tell many of you experts that governance, data availability, investor protections, rule of law all come up a lot in terms of the basics for capital markets to bed in and grow, and thus be able to receive the development finance and impact capital in emerging markets and developing economies. But we must remember that some of the countries, especially the ones that ironically need the climate and impact capital the most, are dedicating that same policy bandwidth to more fundamental issues like roads, electricity, infra. So the types of regulatory scaffolding that would allow building the types of capital markets at scale to then receive, in this case, the millions to billions more likely, are taking longer. Let alone for them to think about design and sometimes have to forfeit tax earnings in the short term by coming up with really cool incentives, which I will also give some examples of. Another factor in the gap to reach the billions to trillions agenda is the lack of policy alignment in the global financial architecture. We can't fault emerging markets and developing economies when the global financial architecture largely was not built for and by them, and in some cases is stacked against them. One really big oversight is global coordination on tax evasion, which leaches money that could otherwise go into development. So for example, Africa alone loses 80 to 90 billion a year for illicit financial flows that are primarily tax evasion and capital flight that could otherwise support development on the ground. But also the ways that risk are priced, the ways that standards are set, means that essentially most emerging markets and developing economies, particularly in Africa, are price takers in terms of capital flows. And we have a great paper called Financial Regulation and Capital Flows to Emerging Markets and Developing Economies, done by Risk Control. Don't worry, I'll be sharing some links if you want to dig into the regulations and why they would lead to more punitive pricing for some emerging markets. Lack of local investment, especially in Africa. There's huge conglomerates, there's billionaire families, there's pension funds, other asset owners in each of these countries, and many of them still keep the majority of their wealth in the OECD. For example, African pension funds and ultra-high net worths hold over 500 billion in assets, yet less than 3% is invested in local SDG-aligned ventures. And then finally, if I haven't exhausted you enough with all of the problems, there's the lack of connectivity between the worlds of development aid and finance. So I work on a lot of different donor programs and donor initiatives where we come across really inspiring climate funds, impact funds, and ventures. And when we are interfacing with wealth managers and other co-investors, it's shocking that there are actually a lot of families and investors that do have appetite, but never the twain shall meet. It's very rare that they're talking to DFIs or talking to development assistance providers and implementers or talking to donors. So part of this is a connection and connectivity issue where we're just in different silos. I promised that I would lead us to somewhere where we can see some bright spots, and I can get more into them in our questions, but I did want to say that, yes, the Black Swan event was stark. Yes, the crossing of planetary boundaries is terrifying, but all we can do, those of us that are practitioners, researchers, financiers, all we can do is get up and fight another day. And there are bright spots. There are countercurrents in impact investing and development finance and private sector flows and policy changes that give me hope and excitement that we can turn this ship around. Unlocking the DFIs. There's many ways to unlock the DFIs so they can take more risk. So many, and some of these are happening, and I can talk more about them, but worth calling out securitization. One of the donor initiatives that I work on, which is Mobilist, has done a recent transaction to help DFIs unlock more capital. So if you think about it, a lot of their capital is held up, whether it's private markets or just stranded and different financial institutions or other transactions. So securitization is a way to take all of those assets, which are not circulating in these EMDAs anymore, sell them on so that that capital can then be freed up. So IFC just did that. It's called the Emerging Market Securitization Program. It's a 500 million transaction, was listed on the London Stock Exchange. That's 500 million that's now freed up to hopefully go to more green, climate-friendly, inclusive growth, as we mentioned. As I mentioned, when it comes to doing blended finance better, I'm really bullish on the power of guarantees and unlocking capital. The OECD showed that their mobilization rates are trending more towards 4x. Some of the ones that I find inspiring are the Green Guarantee Company, which I can talk more about when we sit down, the Investment Mobilization Collaboration Alliance, which is Denmark, Finland, Iceland, Norway, Sweden, and they do a combination of grant and guarantees. So it's like they're basically intending to cover the entire capital stack so that everyone is de-risking each other. The Norwegian Sovereign Guarantee Scheme for Renewable Energy is another one, which is a 5-year pilot with a budget of 5 billion krona. I already mentioned the problem with liquid products and the need for more liquid products. October, a liquidity guarantee facility was recently launched, which basically aims to provide liquidity for some of these fund managers that otherwise would require you lock up your capital for 5 to 10 years. We've seen family offices stepping up to fill the gap left by the retrocession and donor funding. And I would love to highlight the fact that in 2024, over 3 billion was deployed by these local investors in emerging markets and developing economies. They're converging in a few different aggregators, so definitely keep an eye out for the likes of the Impact Office, Tonic, and TrimTab, which is one of the first truly impact first family office founded vehicles. And then also local institutional investors are stepping up. Prosper Africa was one of the pioneers, which was USAID backed. Some of our work with other donors has seen support to local institutionals. I'm really happy to highlight our FCDO-funded RISA program supported a feasibility study, which led to a local fund manager called Chigaba raising from a local Ghanaian pension to deploy in the agriculture space, so as a fund of funds. African sovereign wealth funds have really been stepping up, particularly the Nigerian Sovereign Wealth Fund. And exciting news is that a group of African sovereign wealth funds have joined together to create an investment platform called the African Sovereign Investors Forum. So there's these bright spots. And I know that this has been a whistle-stop tour of these bright spots, and we can sit down and delve into them. And if anyone wants to double click on them, feel free to raise them in the comments. But these are the bright spots that help me get up and face the day, because yes, as I open my talk with, there's been a lot of headwinds, and sometimes it feels the odds are stacked against us. But it's through collaboration, it's through mutual de-risking, and it's through innovation that we can surmount this and try and turn the ship around, as I alluded to in the beginning. So thank you for your attention, and happy to talk more.
So thank you very much, Tara, for the talk. You covered a little bit about the background. You explicitly mentioned some barriers, but you ended up with some very good projects. So which is a good news for us. And you did not even only mention DFI, but you mentioned the individual investment portfolios. I heard from my friends, actually, they told me they have bought something green, clean energy, but the stock has been going down sharply. So that leads to the issue here. So how do we evaluate where we are in terms of the outcome of this impact investing? So that's something that I have been thinking about. Myself has not been really investing in detail on this specific topic, but I know that I can remember when I was a PhD student, so we were told that there is a theory which is called the corporate social responsibility. So we all started from years ago based on this corporate social responsibility theory. And then we saw the social entrepreneurship, we saw the inclusion, and now we are getting a higher level talking about climate. So this is basically where we are in terms of the theoretical development. So my point is we have been taught about this for very long. And in the past, maybe even more than a decade, we have been observing this as the so-called impact investing. But where are the outcomes? I digged a little bit with you, and I thought maybe being sensitive or being controversial is good, but you say, okay, I understand that you have to be political correct. However, I was worried about, so because we have been talking about the whole morning about the patient capital, about how to facilitate private capital. But from economic theory, they care about the risk and the return. So how do we guarantee that we are talking about private, right? Private capital, profit, return probably is the most important concern for them. And we saw the example in the UK. So when we remember in 2022, when we had that mini budget thing, pension funds, they sold very quickly. So my first question is, can you comment a little bit about, are you really confident in this, in the let's say positive outcomes of this long battle? Taking green as an example, climate transformation, green transformation. To what extent are you confident in the outcome?
It's difficult because while impact investing has swelled momentously, especially over the past 20 years. So in 2012, it was about 20 billion, and now the estimates are ranging from 1 to 2 trillion. And again, those ranges vary a lot because it depends on whether or not you're considering development finance. It depends on whether or not you're considering grant, which theoretically is not an investment, but what if you're using a grant to de-risk, et cetera, et cetera. So there's a huge range. But with that swelling, certainly you can see things like, yes, all of these impact funds have backed companies that have led to hundreds of thousands of jobs, and all of that is documented. A lot of the green investments have led to, tons and tons of renewable energy production and GSG reduction. Where it gets tricky is, one, would that have happened anyway? How much of that was already slated to happen, was already commercially attractive, and thus uh, would not have necessarily been called an impact investment? Or how much of that was just purely based on the commercial merits? And by the way, I'm not saying that it should not have commercial merits. I do think there's plenty of really exciting investment opportunities where you're going to see amazing GHG reduction and you can also earn 20%. I'm just saying, how much can we claim attribution? How much can we claim this is additional incremental impact? And that is an interesting debate in the ecosystem, so much that I believe it was BII who commissioned a study on this, on additionality. The topic is additionality. So I don't have an answer on the additionality. I'm happy to share the research report, but I think it's so nuanced that we don't have an answer to that. I can say, yes, job creation, GHG emissions reduction, you can document that there has been changes, positive changes, but we also have to contextualize against broader shifts. So it's like, well, yes, we can do all of these renewable energy products, but if tons of countries are also increasing fossil fuel production, it's still going to be eroded by that. So you can never isolate these factors. You cannot isolate the impact of the impact investment as well. I'm sorry that's not a neat, clean answer, but such things are often
Yeah,
multi-layered.
thank you very much for at least we know where you are. So I actually, you mentioned something about what is that? The blended finance. So we have seen some measures or mechanisms. So can you, given you have a lot of experience in practice, so do you have a concrete example that can show the effectiveness of one particular mechanism that you can use to attract private capital?
Can I do two?
Yeah, you can do two. You can do three if you like. Yeah, please. Yeah.
Yeah, because it's really good to see what can happen when donors step up and how actually sometimes it does actually work. So one example is green bonds. We need all of these green bonds in emerging markets and developing economies. I already gave you the stats that compare European green bonds to green bonds in some of the emerging markets, developing economies. You know, we're not there yet. Part of the reason is because no one wants to finance them. And part of that can also relate to several factors on the ground. The investment attractiveness, even at the ground, as far as the regulatory environment, et cetera. We need these green bonds, and part of the issue is the way they're priced. So Mobilist did a deal, which is a perfect example of a blended finance transaction. USAID came in with grant to de-risk. FCDO put in equity into the vehicle, which actually had its first close at 100 million. What does it do? It provides a guarantee to the green bonds, which then improves the commercial attractiveness of the green bonds. So it gets the capital flowing to green bonds. Through the de-risking of USAID and FCDO, commercial investors like the Nigerian Sovereign Wealth Fund were then able to come in, which is how it got to its first close of 100 million. I think it's on track to, probably 200 million by now. This was over a year ago. So that's a perfect example of a real gap in the market when it comes to addressing climate change and how you can use the catalytic and patient capital in ways that actually do bring in private investors. I have another one, and it's quite close to my heart because I'm a gender equality warrior. and this is the orange bond. So if the
Okay.
green bond is the green bond, the orange bond is addressing SDG 5 and SDG 10, which are gender equality and equality more broadly. So what's interesting is that we all know that women's repayment rates in microfinance are actually really, really good. So they shouldn't be treated as a high risk investment, but often microfinance in the past, some of which has abated, and SME finance in emerging markets is seen as high risk. So IIX in Singapore wanted to back large scale portfolios of loans to women entrepreneurs across Asia. They got, I believe it was also USAID, rest in peace. And I think it was the Australian government to provide the catalytic layer to that. And it did so well, it listed on the Singapore Stock Exchange. And it eventually attracted the likes of large scale institutional investors. I think Temasek and TIAA eventually came in, which is a large scale institutional investors that have a commercial imperative. And now I think it's done its 5th listing. It continues to be successful. The women have like a less than 1% default rate. And they try to do it in ways that they're also backing climate friendly businesses. So I think these are really examples of how you can use the donor blending, actually get commercial capital in the door to have impact in ways that surely you can show are really needed, whether it's from a climate or a gender equality perspective.
Yeah, that's good examples. I think we have maybe a bigger issue, and that is something to do with the reform. So if we think about the emerging markets and developing economies, they very often, they do not have a well-developed financial market or financial system. So if you were a policymaker, you are probably a policymaker already, and you are given the opportunity to unlock at least 1 billion US dollars, and what would be that measure, that reform measure that you can put forward and that you want to see the outcome?
I'm going to give a broad one and then a more tangible targeted one, because it's always nice to have case studies. So the broad one really highlights the fact that we are all on this journey and we all have a lot to learn from each other. No one has cracked it. So I'm sure you all have seen here in the UK the debates going on around how fiduciary duty is defined, and that is an imperative that's then pushed on pensions. So right now that debate is going on as far as how it is enshrined a fiduciary duty of an asset owner, like a pension. If that changes, it can be transformative. In the US right now, it's being led out of the US, but it's started to also have some influence here. There's an initiative called the Investment Integration Project. And basically what it's asserting that if you are a long-term asset owner, like a pension, where you have a 20-year plus time horizon, you need to consider climate and equality as drivers that will affect your portfolio's performance, i.e., it's actually your fiduciary duty to do so. And we're already seeing this in the US, where we had all of those fires in California. We've had hurricanes in Florida, where the real estate portfolios of large-scale asset owners are being affected. And I have another example from South Africa of that, which is basically South Africa was saying, we have a fiduciary duty to invest for commercial return. We shouldn't look at these social issues like inequality. But then guess what happened? The inequality got so bad in South Africa, which is the most inequitable country in the world, according to the World Bank in terms of wealth, that they started having huge race riots in the early 2020s. And the pensions and asset owners on the ground lost a huge share of the value of their portfolio because 10 to 20% of their portfolio was in real estate. And that real estate got destroyed by the riots. So going back to the Investment Integration Project, the Investment Integration Project is a movement among large asset owners in the US, and they've got some of the UK asset owners. I think Guy St. Thomas might be linked or have received some training from them to say that it's actually part of your fiduciary duty to look at climate and inequality. If that happens, and it's on debate here in the UK, if that happens on the ground in any country, it will transform the capital that is unlocked towards these challenges. That's a big one.
Mhm.
Might take time. A more targeted, kind of easier one, though certainly not easy, are things like schemes like we have in UK, where we have EIS and SEIS, which incentivize wealth holders to back social ventures. And of course, the incentives that are given for renewable energy. So I would love to shout out Morocco, which decided they wanted to become the renewable energy superpower for North Africa and increasingly export a lot of that to Europe. How did they do it? They've had a lot of success doing it only over the past 5 to 10 years. They put a 0% corporate tax. They gave free land, VAT exclusions, and just in a few years, they've got to 38% renewable energy to meet their energy needs. They've attracted over 5 billion in investment. So that, compared to the fiduciary duty change, might be like a more targeted tactical approach, and it certainly seems to be successful. And I really wish Morocco the best with it, and I think others can learn from it as well.
That's really nice. So examples are really encouraging, and I trust you because you have touched upon the individual cases and you know more about that. So so I think we can now open we can have open to the audience to have Q&A sessions. I can pick up some questions. So Tara, do you prefer that we collect 3 questions in the first instance and then you respond, or do you prefer one by one?
As you wish.
It depends on whether we have the questions, please. Yeah, of course. Ganesh is already there. Ganesh, please introduce yourself.
Thank you. Ganesh Vignaraja, I'm a visiting senior fellow at ODI. My question really concerns DFIs, and you talked about stepping those up. And I have 2 questions on that. One is, what specific actions would you like to see DFIs do, given that there's an issue of capital adequacy and things of that type? So what specific actions? And second, do you think DFI coordination is really the way to go amongst themselves? Thank you.
So what's interesting with the DFIs is that it needs to be at the top and the bottom. And by that, I mean, we need initiatives that are at the more large scale institutional grade side, i.e., investments that are large scale or that have a public market focus. So you can crowd in the hundreds of millions or more billions from institutional investors. And BII has an example of that, which is the mobilization facility, where they're actually using, I think, City of London Corporation investment consultants to select products that they believe will attract large-scale institutional capital. We know that when that happens, often that's going to veer more towards the middle-income countries, the more well-developed capital markets. So then what happens to both the lower-income countries, but also the kinds of innovations that are really transformative on the ground in terms of impact? And I'm talking about things like climate smart agriculture, where we're just not far along, where most of these are large scale and institutional grade. So we need the catalytic capital facilities on that too. BII has that. They have BII Catalyst. FMO also has something similar, which is FMO market creation. So I like how BII is addressing the bottom and the top. I believe FMO has some similar, but I don't know if these are widespread across all of the DFIs. And mind you, a lot of the DFIs are a lot smaller. BII and FMO are among the biggest, so they can have all of these different facilities. But it would be great to see more more DFIs echoing that. And that also pertains to your second question, which is around the coordination. What's hopeful is the fact that DFIs tend to drag each other along. So it would be wonderful to see more replication of those instruments in the coming years.
Okay, thank you very much for that question. And thanks for the question as well. We have a second question here, please. Introduce yourself, please.
Yeah, hello, my name's Gareth Smith, and I run the economic development section of the New Zealand Government International Development Program. So we focus 60% of our ODA funding on the Pacific. So very sort of small, remote, shallow frontier markets, I guess. And so it's that situation where Fiji has a bit of a capital market, but a lot of the other countries don't. There are, you know, countries which have 1,500 people or 10,000 people. So I'm just wondering if you have any experience or suggestions for that sort of very early stage. I mean, at this point, we have some programs where we provide capital guarantees or wholesale capital to the small local commercial banks and development finance institutions, you know, very small sort of deal sizes. We're looking at developing an impact fund that, yeah, blended finance, where we provide grants and de-risk capital. But the question is, yeah, do you have any advice or experience at that very early stage where economies are small and capital markets are not yet developed? Thank you.
I can't say I have experience in the Pacific when it comes to early stage, but I have someone that might, and this does not constitute investment advice. This constitutes me hoping to make a connection that could be useful. There's an impact fund that came through one of our programs, which was Matanataki, if you've come across them, which is gender lens, ocean economy, and early stage investment in the Pacific. It's the only one I've seen that pertains to what you've just mentioned. So I got excited when you mentioned the question, because I only know one example, which also pertains to the point you made about the shallowness of that market.
Great. So I think you are talking about the orange bond. You are talking about that project that makes your talk even more interesting, because I think as a woman myself, I also care about you know, what are the opportunities for us to lead in this area, in impacting investment, in a bigger issue and things like. But I need to investigate a little bit more about the orange bond and see whether I can get in. So any other questions? So we still have a few minutes left. So yes.
Hi, I'm Jahari. I just recently finished my master's in climate finance. And I have a few questions, which I hope to talk to you later. But one thing I've noticed is a lot of terms coming up and lack of standardization with things like green bonds, blue bonds. I don't know about the orange bond. But how do you kind of convey that to an investor and let them know, like, okay, this is a serious thing. We might not have the right standardization, maybe sometimes even the data with some of the countries that it might be going into. So how do you kind of like go about those conversations when talking to investors or institutions?
I mean, conveying it is not a problem, but the lack of standardization is the problem itself. Meaning we can convey that, you know, there's not the data on the ground, the standards aren't consistent. The issue is now there's even less, the kind of funding that would fund standardization, research funding, market building funding, that funding is more constrained than ever. So the likelihood that we'll get there on standardization appears to be possibly crimped in the future. And that's when it's going to take more of the catalytic funders to step up. Is that going to be the donors, or are there going to be some like really forward thinking foundations that are addressing this? Might be a little of the latter, because I do see some of these foundations, like I think Climate Works, there's a few foundations that are looking at this in terms of the architecture of climate finance itself, but I'm not sure who's funding what as far as standardization. I just overall agree with your point about the lack of standardization and the lack of data.
So I was also thinking about who is that person who set up the standard. So by standardization, we need whether the government or organization, where do you put this? Do we put this into regulation, or do we put this into, I'm still thinking about it. So who is going to do this? Who is going to standardize everything?
That's a good question. And as I said, it's the likelihood of that being funded at the scale needed is going down over time.
Interesting. So so let's think more about that. And do we have Any more questions? Yes, Marcelo. Yeah, please.
One question, take a look at the bigger picture. When you see the recent retrenchment, right, in funding available for development, in your view, what are the main causes behind it? And therefore, taking that into account, looking ahead for years to come, what do you think are the prospects?
It's a lot of it linked, well, there's a few things. The trajectories of growth that we had in the past, as far as economic growth, are not realistic to rely on in the future. So as growth is constrained within countries, but particularly the OECD countries, of course, people are going to say, why should we prioritize aid? And that's what we have seen. There's also a social cultural element, some of which may be linked to social media, which is social cultural trends as far as the way people see each other and who is part of my community and who is not. The factors that have led to this shift, both on the economic side and the social cultural side, they don't seem like they're going to change in the near term, but I certainly do hope they do. We were all really struck with the shocks to aid funding over the past few years and the forecast going forward. But I am seeing a different cast of characters start to rise to the occasion. And that's why a lot of my work is kind of the interstitium, linking together other players in a broadening cast, where it reflects more of the multipolar world that we now live in. It's a great question, by the way. Thank you for asking it.
It's all great questions. So I think we are 1 minute over the time, but okay. So we have at least we can pick up one question from online audience.
It's my mom. No, I'm just kidding.
Okay. Oh, really?
No, I don't think so.
How should the FIs be structured in a fragile environment? And what development agenda can be useful for DFI? Can be useful for DFIs under such a circumstance. Can you elaborate a little bit? Can you?
I mean, I'm not deep into the.
Sorry, there is an example. Take an example of Somalia or South Sudan.
How would a DFI address Somalia and South Sudan?
So maybe we focused on this example,
I see. It's been a subject of debate. I'm not sure who follows those hearings on international development that happen every year around the aid spend in UK, but it has been a subject of debate for years here, the extent to which our DFI here in the UK is funding the lowest income countries and the most fragile countries. Obviously, when you look at the broader FCDO and HMG priorities, conflict affected states, they do rise to the top. But if you were to look at BII, at least last time I looked, and I haven't looked this year, by the way, those states were definitely not near the top at all. And the reason was, because of their risk profiles. There are, however, donor initiatives that are trying to address this. It's called ARIA, I believe, ARIA, which is like a BII initiative, I think maybe with FMO, which is trying to address the fact that at least these two DFIs were a little bit underweight, lower income and more conflict affected. I don't know how deep they go as far as conflict affected, but we all can acknowledge that the DFIs, they have to be financially stable. They have to sustain themselves in some cases. So they typically have not gone very deep in conflict affected. And I've spent time thinking about how we can match. We run a lot of donor programs, including in conflict affected countries. We have a really big presence in Ukraine. We have a really big presence in Syria. And I run all of these initiatives around capital mobilization, where I'll bring together family offices and wealth managers to talk to DFIs about gender lens investing, for example. We actually had an event in Switzerland where we brought together FMO, as well as some wealth managers and ultra high net worth women to talk about gender lens investing. So I'm keen to find ways to merge or converge our programming, our donor programming, and some of the conflict affected states with a broader cast of these other allocators. But what I'm seeing is that there's such a small pool of allocators that are willing to go, that the risk is still perceived as being so high. So it's likely that that's going to need to start with local capital. And I do think in some of those markets, I can't say for South Sudan, because that's a very specific case, but some of the lower income countries, the local capital, as it rises up, can leverage and attract the DFIs. And we see that with more the middle income countries. Some of the funds that have come through our programs, they started off raising from local ultra high net worths, banks, and then on the back of that, they were able to capture the DFIs on their second or third fund. And I think in some of the lower income countries, it would be the same trend. The issue is the conflict affected or the fragile ones, where I actually feel like more likely, and I haven't done case studies on this, it is still a small segment, it's still going to be more likely going to need donor de-risking, not DFI de-risking, donor de-risking. That's my assumption. I haven't done any case studies on it, but one thing I did want to mention, I've mentioned lots of case studies, research, transactions, some of which have come through our programs. I've also mentioned a few initiatives. So after this, once I have this keynote, I'll share it on my LinkedIn, but beneath it, I'll put all of the hyperlinks to the research or the transactions or the initiatives I mentioned. So when I do that, I will look through the Humanitarian Finance Forum and to see if I have seen any examples of DFI de-risking and conflict affected. I would love to see it. And if I see it, I'll definitely share it with the group when we share this keynote.
Yeah. That's really wonderful. So I think we have covered quite a lot on this topic. Actually, we furthered the discussion based on this morning's panel discussion as well. So I think we need to conclude the session, and I thank everybody. Tara, thank you very much for your time, for your effort on making this speech. And thanks everybody for your contribution to the questions. And I hope the session is informative, insightful, at least. It's lunchtime, Dirk, right? How do we do we have any other conclusion, or I conclude? So yeah, we can close this session.
Thank you.
So let's give a clap to Tara. Thank you. Thank you very much.